Hello everyone. So right now we are on our day 6 and we are going to read a new sum and I will be solving this. So in the previous lecture what we have studied is that we needed to calculated the weighted average cost of capital on the basis of the book value weights. So in this sum what we are going to study is that we are going to calculate the weighted average cost of capital by market value weights. So I will not be doing the book value, I will be doing the market value weights. So we are reading the question. You are required to determine the weighted average cost of capital in KC Limited using book value weights and market value weights. The following information is available for your perusal. The KC Limited present book value capital structure is debentures 14 lakhs, preference shares 3 lakh 50, equity shares are 17 lakh 50. So what basically this portion which they have given to you is the book value. All those securities are traded in the capital market. Since all the securities are traded in capital market, it means there is a market price available. So recent prices are debentures at rupees 108.25, preference shares at 121.25, equity shares at 22.135, and anticipated external financing opportunities are rupees 100 per debenture is redeemable at par, 20-year is the maturity, 8% is the coupon rate. So coupon rate is nothing but the interest rate. 4% is the flotation cost and the sale price is 100. Rupees 100 preference share redeemable at par, 15-year maturity. There is 10% dividend rate, 5% is the flotation cost and then it's a sale price is 100. Equity share rupees 2 per share, flotation cost. Okay, equity shares rupees 2 per share is the flotation cost, sale price is 22. In addition, the dividend expected on equity share at the end of the year is rupees 2 per share. The anticipated growth rate in dividend is 5% and the company has a practice of paying all its earnings in the form of dividends and the corporate tax is 50%. So it is a comprehensive sum which is going to test each and every part of your exam. So it's an important sum from the CA Inter exams. So right now what I am going to do is I am going to solve as per the data given to me. So first I am going to solve the cost of debentures. So cost of debentures I am going to solve right now. So cost of redeemable debentures, and this will be termed as KD. So cost of debentures is nothing but interest 1 minus the tax, which is the tax saving, plus the redemption value minus the sale value, divide by the number of years, and the average redemption value plus the sale value divide by 2. So this is the formula for it. So I'm taking a timeline over here. Okay, rupees 100 per debenture redeemable at par. So the redemption value is 100 rupees. The face value is 100 and they are redeemable at par, means they are redeemable at the same face value, which is 100. 20 year is the maturity, so N we know it is 20 years. 8% is the coupon rate, so we can find out the interest. And I've told you all that the interest is always calculated on face value. So the face value of the debenture is 100 and the interest is 8%. So on 100, 8% on 100 will give me an interest of rupees 8. So I will be having 8 rupees as my interest. 4% is the flotation cost. Now since the institute is taking the flotation cost at the face value, so I will be taking it at the face value only. So if you want, you can take it on the issue price, that is the sale value also, both are right. So I'm taking it on the face value. So 4% is the flotation cost. So my flotation cost is face value into 4%. So the face value is 100 into 4%. So my flotation cost is 4 rupees. And the sale price is 100. It means I've sold one debenture at rupees 100. So the sale value is 100. Out of this I will deduct 4 rupees as flotation cost, and the net proceeds, the net amount which I will receive is 96 rupees. So 96 rupees is the net amount I am going to receive. So all these things I am going to put into this formula. So interest is 8, then 1 minus the tax. How much is the tax rate? 50%. Okay, so 0.50 I will take it my tax, plus the redemption value is 100, okay, minus the sale value is 96. So sale value is 96, divided by the number of years is 20, upon redemption value I will take it as 100, plus the sale value I will be taking at 96, and this I will be dividing by 2. So I'm solving here. So 8 into 0.5 will give me 4. So 100 minus 96 divided by 20 plus 4 is going to give me 4.2. So basically I've solved this entire numerator. Now 196 if I divide by 2, I'm going to get 98. So I've solved this part, and this we are going to multiply by 100. So 4.2 divided by 98 and percentage. So I'm getting 4.29. So 4.29% approximately is the cost of debentures. Now we have to find the cost of preference shares, and these preference shares are redeemable preference shares. So my next working note is to find the cost of redeemable preference shares, which we will take it as KP. So cost of preference shares will be your preference dividend, which is paid per annum, plus the redemption value minus the sale value divided by the number of years, upon the redemption value plus the sale value upon 2, and this entire thing we are going to multiply by 100. So I will be making a timeline over here. So this we are studying rupees 100 preference shares redeemable at par. So they are redeemable at par. So the redemption value is same as the face value, which is 100 rupees. 15 year is the maturity. So 15 years is our N. So N is equal to 15 years. Okay, then 10% is the dividend rate. So 10% is the dividend rate, and I've already explained you that the preference dividend will be paid on the face value. So face value into the rate of dividend. So how much is the face value? The preference shares are having a face value of rupees 100. So 100 is the face value and 10% is the rate of dividend. So 10 rupees is the dividend per annum. 10% is the rate of dividend. Okay, 5% is the flotation cost. So I have explained you all that the flotation cost, we are taking it on face value. So face value into the flotation cost, which is 5%, and face value are aware is 100. So 100 into 5% is going to give me 5 rupees. So 5 rupees is my flotation cost, and the sale price is 100. It means I have sold one preference share for rupees 100. So my sale value is 100, and out of this 100 I have spent 5 rupees as my flotation cost. So in my hand the net proceeds are 95 rupees. So now we will be substituting all the data into the formula. So it is the preference dividend. The preference dividend is 10, okay, plus the redemption value is 100 minus the sale value, it is 95, divide by the number of years, which are 15 years, upon the redemption value is taken as 100 plus the sale value is taken as 95, and this you can divide by 2, and this whole we are going to multiply by 100. Now I will be writing the answer over here, so you have to be careful and look carefully. 100 minus 95 divided by 15, 0.333 plus 10. So in the numerator I am going to get 10.333. Now denominator is 195 divided by 2. So in the denominator I am going to get 97.5, and this whole I will be multiplying by 100. So the answer is 10.333 divided by 97.5 and the percentage. So I am getting 10.60%. So I am getting 10.60%, and this is my cost of preference shares. Now we are moving. Now we have to find the cost of equity shares, and these equity shares, since you can see that there is growth, so we have to find the equity shares as per the dividend growth model. So we are going to find the cost of equity, and we are going to find it by dividend growth model, and the cost of equity is your future dividend divided by the current market price minus issue expenses plus the growth rate, and this you will multiply by 100. So the equity share rupees 2 per share flotation cost. So I will write the data over here. The flotation cost means issue expenses is rupees 2. So rupees 2 is the issue expense. Sale price is 22. It means the market price. I'm selling that equity share into the market at a price of 22. So rupees 22 is the current market price. In addition, the dividend expected on equity share at the end of the year is 2 per share. So they have given that this is the dividend at the end of the year. In other words, they are giving you the expected dividend, which is D1, which is 2 per share. So we know D1, which is rupees 2. The anticipated growth rate in the dividend is 5%. So they have given us the growth rate, which is 5%, or you can take it as 0.05. And okay, and the corporate tax is this. So all the details we are having it, so we will put into a formula. The D1 is 2, the P0 is 22, the issue expenses are 2, plus the growth rate is 0.05. 0.05 is the growth rate, and this entire you need to multiply by 100. So 2 divided by 20. 2 divided by 20 plus 0.05 into 100 will give me 15%. So I have found the cost of equity, which is 15%, and you should be watching the lectures as and when it is being taught. So I am going by the concepts I am moving forward. In case if you watch a lecture in between, then you will find it difficult to understand it. So right now we are moving to the sum. So I think I have done everything. Now we have to find the market price over here, so that we are able to find. So what we are going to find? We are going to find the market price of our securities. So all these securities are traded in the market. So first 14 lakh if I divide by 100. So how many debentures I'm having? 14 lakh if I divide by 100. So I'm having 14,000 debentures. So right now I am having debentures, that is 14,000 debentures I am having. Now the recent price of debentures are traded at 108.25. So 108.25 is the price of one debenture. So the market value of my 14,000 debentures will be 14,000 into 108.25. So it will be 15,500. Then the next thing is 3,50,000 I will be dividing by 100. So 3,50,000 if I divide by 100. So I'm having 3,500 preference shares. So I am having preference shares. So I am having preference shares, which is 3,500 preference shares, and the preference shares are traded at 1 to 1.25. okay, so 1 to 1.25 they are traded. So 3,500 into 1 to 1.25, so 424,375. This is the market value of the preference shares. Then 17,50,000 I will be dividing by 10. 17,50,000 if I divide by 10, I am going to get 1,75,000 equity shares. So equity shares which I am having is 1,75,000 equity shares, and the market price is, the equity shares are at 22.135. So 22.135 is the market price per share. So 1,75,000 into 22.135. So 3,873,625. So what I have found out I have found out the entire market value, since I am going to find the weighted average cost of capital through the market value. So we are going to calculate the weighted average cost of capital, which is known as KO, by using market value as our weights. So now you have all your sources, then you have the market value, then you will find the weight of that market value, then you have cost of capital, which will be in percentage, then weight you are going to multiply by the cost of capital percentage, which we say WACC. So all these things we are going to do right now. And in book value, it's nothing but instead of market value, you will take all the book value which is given in the question. Okay. So debentures, we have 15, 15, 500. So we have debentures. We have debentures 15, 15, 500. Then we have preference shares 424, 375. We have preference shares 424, 375. Okay. We have equity shares 38, 73, 625. We have equity shares 38, 73, 625. 38, 73, 625. Then what we are going to do, we are going to add all the three market value 15, 15, 500. Let me check whether there are any retained earnings or not. Okay, there are no retained earnings. Okay, 15, 15, 500 plus 424, 375 plus 3873, 625. So I'm going to get 58, 13, 500. Okay, and this is the total of your weight should always be coming to 1. Now this you have to divide by this. So 15, 15, 500 you divide by 58, 13, 500. So the weight you will take up to 3 decimals. 0.261 I'm taking. So this I will divide by this figure 424375. I will be dividing by 424375. Okay, dividing by 58, 13, 500. So I'm going to get 0.073, and this we are going to take it as balancing figure since these two parts I have rounded it off. So this we are going to take it as balancing figure. So from 1 rupee you are going to subtract this 26 paisa and this 7 paisa. This you have to subtract. So from 1 I am subtracting 0.261, 0.073. So I am going to get 0.666. Let us check this. We divide by this, what answer we get? 38, 73, 625 divided by 58, 13, 500. So we are getting the same answer only. Then the debentures cost of capital is how much? So the debentures cost of capital is 4.29. Okay. So here I will be writing 4.29. This will be remain in percentage. Then preference shares. So preference shares. So I have to check further. Okay, preference shares, the cost of capital is 10.60. Okay, so the preference share cost is 10.60. Then equity shares Okay, equity shares, the cost is 15%. 15. Then we are going to multiply this and this. So 0.261 into 4.29. So I'm getting 1.11969. This will multiply by this. 0.073 into 10.60. So I'm going to get 0.7738. So in this we are multiplying by this. 0.666 into 15, that is 9.99. Then we are going to add this. So this we are going to get the overall cost of capital, 1.11969, 0.7738, 9.99. So I'm going to get 11.88% as my overall cost of capital. So what you all will be studying at a very minimum rate of rupees 100, and all the lectures I will be teaching in this manner only. From now all the lectures are private. This is the last lecture which I will be keeping it open, and the remaining lectures will be private. It will give a YouTube link will be given to you at your email address, and then the details you can check out at the description box. I hope you like the teaching and you will buy it. Thank you.